Okay, if you only looked at the headline S&P number today, you'd think we had, I don't know, the most boring Thursday on record.
Absolutely. Just a flat line.
But if you were actually watching the internals, you know the tape was performing major surgery. It was slicing away risk while trying desperately to hold a few key
A
levels.
lot happening under the hood.
So our mission today is pretty simple. We're diving deep into this closing print. Was this session really just chop? Or did institutional money use that flat index as cover to either distribute or accumulate?
That's the billion-dollar question.
The goal here is to distill the conviction, or, the total lack of it, and set a clear strategy for Friday's open, especially with that huge earnings wall starting at dawn.
A monumental one.
Let's get right to it. The scoreboard. The final numbers tell a story of, well, marginality.
That's putting it mildly.
The S&P 500 finished up a barely visible plus 0.12%.
Barely.
The Nasdaq, which really needs to lead for any kind of continuation, it lagged. Closed fractionally down, minus 0.05%.
And that's a worry right there.
The outlier, though, and this confirms a flight to safety, maybe dividend strength, was the Dow. It outperformed with a solid gain of plus 0.28%.
That marginality is the whole story, and the verdict is already in. The session was, technically and psychologically, a choppy mess.
A complete mess.
There was zero directional conviction. Once that initial geopolitical relief rally faded, we'll get to that, it just died. We spent the day oscillating in these tiny, tight intraday ranges.
A classic holding pattern, but why the paralysis? I mean, we're used to seeing money flow towards some kind of direction, but today it just felt like the smart money was sitting on its hands. What froze the tape?
It boils down to two huge forces creating this wait-and-see environment. First, and the most immediate, is that looming earnings wall that starts tomorrow.
Go Friday.
Exactly, Bank Friday. You've got JPM, Wells Fargo. They set the entire emotional tone for the season. And nobody wants to commit serious capital right before those massive prints.
But we did get some fresh macro data today. The PPI came out. Usually inflation data, even a second-tier one like PPI, gives us something, some clarity. Why was this one just ignored?
That's a sharp observation. The PPI data was lukewarm. I mean, it wasn't hot enough to trigger inflation fears, but it wasn't soft enough to confirm the soft landing thesis we need.
So it provided nothing.
Nothing. It failed to give the market a clear, decisive signal for the Fed's next move. So the market just punted. It basically said, let's wait for the real news tomorrow, which is, of course, the bank earnings.
Okay, so if the headline was messy, let's let under the surface. The sector leaderboard. Where did some conviction actually exist?
You saw two very clear trends. Financials were the winners, no question. They caught a substantial bid as yield stabilized. Investors were basically front-running strong trading revenue from the big banks.
A preemptive bet.
Right. But the real tell and the risk was the laggard. Technology, specifically the semis. They really struggled with profit-taking today.
Even with the TSMC news.
Even with that, the overall sector is just facing valuation fatigue after this incredible run. And look, tech has to lead if we're going to break out. Today, it just looked tired.
And that leads us right into the hook for tomorrow. If the market is paralyzed by earnings, then these first reports are the most critical.
Precisely. All attention is on JPM and Wells Fargo. The market right now is priced for perfection. It believes the economy is strong, yet inflation is cooling.
A dangerous combination.
Very. If the guidance from these banks fails to provide that growth catalyst, if they signal any slowdown in lending, consumer activity, then this nervous neutral sentiment pivots hard.
And fast.
We could see a swift defensive sell-off by noon Friday. All the growth forecasts get pulled down.
All right, let's turn to conviction. We closed green, barely. But was anyone actually home? Let's check the volume validation.
The real money footprint.
S&P 500 volume, 871.25 million shares. Our 30-day average is 888.62 million. So we came in just below, around 98%. That data tells you something right away about the quality of this move.
It screams low conviction. We call this a low-fat move. For a market that's been consolidating just below all-time highs, you need volume expansion.
Surge.
A huge surge above average to confirm that institutional money is really committing. The fact that volume was so subdued means this was not some high-conviction breakout. It was a tactical bounce. More of a vacuum of sellers than a flood of new buyers.
Okay, so if the volume was low, who was doing the marginal buying into the close? Was it just passive stuff, or were institutions making a targeted bet?
The data suggests that, yeah, key institutional desks were buying the close. And what's fascinating is that despite all the chop, the Nasdaq held on to its fractional gains right into the final bell.
Which means someone was comfortable holding tech overnight.
That's right. It indicates comfort among the buy-side desks. They're not scared to hold these positions into a Friday.
That confidence feels a little counterintuitive, though, especially with the semi-fatigue we just talked about. So what drove that late session conviction?
Two big external drivers reset the whole narrative. First, and this is the most important, TSMC's blowout earnings. A 35% profit surge. That's massive.
A monster number.
TSMC is the linchpin of the entire AI trade. So that print acted like a firewall. It forced anyone short big tech to cover fast. It confirmed the AI capex cycle is robust, accelerating even.
And the second driver?
Geopolitical. President Trump's comments de-escalating the situation with Iran, that removed the geopolitical tax that was priced into oil and the broader index all week.
You saw it in the commodities reversal.
Instantly. The risk just came right off the table.
So putting it together, the institutional bet is that semiconductor strength is a leading indicator for broader tech earnings, as long as the geopolitical front stays quiet.
That's the bet they're making into the weekend.
Which brings us perfectly to the key reversals. If risk came off the table, we should see it in the hedges. Where did the tape flip the hardest today? Where did we see those fear trades unwind?
Oh, it was violent and almost instantaneous in precious metals and energy. Take silver. It hit a fresh all-time record high this morning at 93.75.
Pure fear trade.
Pure geopolitical fear pumping that price.
Yeah.
And then a sudden massive reversal that was just huge profit-taking hitting the metals the second the geopolitical temperature dropped.
And energy got hit with the same stick, right? WTI plunged nearly 5%.
Absolutely. WTI gapped down and just kept fading all day on the easing Iran tensions. It was a classic case of momentum traders who were long geopolitical risk getting caught completely offsides.
Forced liquidations.
They had to liquidate those long futures contracts, which just magnified the drop, a textbook risk unwind.
But there was a fascinating outlier in financials. This gets really strategic heading into tomorrow. We saw Goldman Sachs up 1.8% and Morgan Stanley up 3.3%. A huge low-to-high reversal despite all the pre-market pressure. Why did those two decouple?
It's the M&A thesis. Investors look right past any potential earnings indigestion. They looked past credit quality concerns in the regional banks.
And focus on what?
They're focusing on the surge in merger advisory fees and wealth management inflows. The market is pricing in a massive, accelerating M&A cycle for 2026, and GS and MS are the prime beneficiaries.
So they've decoupled.
Completely.
Yeah.
And that strength is a signal. It tells you big institutional money is rotating back into high-quality banking assets that actually benefit from volatility and deal-making.
Okay, so if we synthesize the market structure right now, what's the verdict?
I'd call it neutral positive. Tech is back in the driver's seat because of TSMC, and financials are showing selective strength. But, and this is a big but, that low volume tells us the heavy hitters are holding significant powder dry.
Waiting for next week.
Waiting for GDP and retail sales. The strategy remains play the range, but you have to keep your risk profile incredibly tight.
We've covered the surface, now we have to go subsurface. Because this is where the real risk is hiding. The whole closing print today feels like an illusion of strength. There's this crucial disconnect between the headline index and the underlying market health.
This surface versus subsurface divergence is the biggest red flag facing you right now. Let's just look at the market breadth data. The S&P 500 closed up 0.2%, so green, but the raw advanced decline ratio closed at 1 to 2.5.
Wait, so for every one stock in the S&P that went up today, 2.5 went down. How is it even possible for the main index to be green if most of its stocks are bleeding?
That is the core of the illusion. This is not a broad rally. Capital is just concentrating intensely in a handful of mega-cap names. It's a magnificent life support system.
So the average stock?
The average stock, which you can measure with something like the equal weight S&P, is struggling. Liquidity is not flowing broadly. When you buy the index today, you're buying a highly concentrated bet on 5 or 6 stocks, not a healthy bull market. And that structure is inherently unstable.
Let's talk about the VIX, the fear gauge. The S&P hit an intraday high, which should cause the VIX to plummet. But the VIX didn't crush. It actually rose 4% to 16.2.
That VIX action screams institutional distrust. A sticky VIX at the highs is an ominous signal. It implies professional desks are aggressively buying protective put options.
Paying up for crash insurance.
They're paying up for crash insurance at elevated levels. It means the smart money does not trust this headline price action, and frankly, neither should you. They are hedging against a failure while the index ticks higher.
Okay, now the technically ugly part, the negative divergence that showed up on the close. The S&P reached a fresh monthly resistance level, but what did the underlying momentum measure do?
It showed a major breakdown. We look at the McClellan oscillator. It measures the breadth and momentum of a move. The index was up, but the McClellan oscillator just hit a 2-week low. This is a textbook negative divergence.
For anyone who doesn't live and breathe this indicator, what is the McClellan oscillator telling us about the quality of a market's momentum?
Right. The oscillator measures the cumulative difference between advancing stocks and declining stocks over time. So when the index price moves higher, but the oscillator moves lower, it tells you the upward move is running out of internal oxygen
The rally is thinning out.
rapidly. Today, despite the flat close, was a distribution day disguised as neutral chop. Large institutions were likely selling into the perceived strength created by those few megacaps.
So given these dire internals, what's the actionable defensive move?
It's clear. Immediately tighten stops on all your laggards. If you haven't been forced out of non-performing small or mid-cap names, now is the time. Cash is a valid strategy here.
And the key level for structural damage.
The 20-day moving average on the equal weight S&P. If that breaks, the megacaps won't be able to hold the ceiling alone. The index will follow.
All right, let's pivot from defense to the highest conviction setup for Friday's open, the gamma pin. We have the levels ready for the bell. The specific play we're watching is a long line on SPX futures, the ES, on a sustained 30-minute hold above 7,007.25.
Let's talk about the why behind that hyper-specific level. The market structure around the 7,000 strike is a real phenomenon. It is currently in a gamma pin regime centered right at that psychological level.
And the dealers?
The dealers are overwhelmingly net short gamma above the 7,000 strike.
So just give us the simple mechanic. What does it mean for the price when market makers are net short gamma above 7,000?
It means if the market moves up quickly toward 7,000, the dealers who sold those call options are losing money and fast. To hedge those losses, they're forced to dynamically buy futures contracts. But they also have to actively suppress the price near 7,000 to manage their exposure. That's the pinning.
So the break of the 7,007 lid is the ignition point.
That's it. It forces those market makers to stop suppressing and start aggressively buying futures to hedge. It flips resistance into a massive rocket booster. If we clear that level, volatility just expands instantly toward the next strike.
What's the reward risk on a structure like that?
The reward is substantial. Volatility expands towards 70-50 very quickly. The risk has to be tight because the moves are fast. The stop should be right at 69995. That gives you a fantastic asymmetric trade if the lid blows off in the first hour.
But you have to respect the structural forces at play. That 7,000 gamma wall is both psychological and structural. A black hole.
You should expect heavy friction there. If the market approaches 7,000 without that heavy volume expansion we talked about, it will likely get rejected. You only want to engage on a sustained break above 7,007.
And what's the absolute must-hold line in the sand on the downside? The one that signals a breakdown.
That's 6,940. There's large negative gamma sitting right there, fueled by all that protective put buying.
Losing 6,940 triggers a regime shift to accelerated selling.
What happens then?
That's the moment the dealers flip entirely. They start selling into weakness to cover their put exposure, and the market risks a free fall.
Given all this, all the choppiness, what's the continuation probability for a strong trend day tomorrow? Honestly, it's low, maybe 35%. Thursday was a low-volume rebound, not a real trend day. We should expect a choppy grind unless that 7,007 level is cleared with decisive expanding volume in the first 60 minutes.
And if it is?
If 7,007 is cleared, then that low probability shifts instantly to a high probability short squeeze day.
Speaking of follow-through, let's hit two specific tickers for tactical day 2 setups no matter what the S&P does.
Good idea.
First, TSM, Taiwan Semiconductor. We're looking for a red to green move or a break of Thursday's high, targeting that 350 psychological level.
That's the right play. TSM crushed earnings, hiked its capex, but remember, real institutional money often takes 48 hours to fully size into these massive upgrades.
So a dip could be an opportunity.
If TSM dips in the first hour, that could be a gift for long-term buyers. If it breaks Thursday's high, that's your immediate momentum validation.
And second, let's go back to financials with MS, Morgan Stanley, the sector leader breakout play.
MS is setting up perfectly for that. Because of the decoupling we saw today, it's being seen as a flight to quality name based on wealth management strength. The setup is simple.
Hmm.
You go long on a sustained hold above today's closing range, targeting that M&A momentum.
Okay, so to summarize the tension from this closing print, we had a marginal low volume bounce. It was fueled entirely by big tech and easing geopolitical fears. But that headline strength is being fundamentally contradicted by severe internal divergence and massive defensive positioning.
Exactly. You've seen a major negative divergence signal. The McClellan oscillator is hitting lows, while the index tries to clear resistance. The conflict is right there, and you're positioned right in the middle of it.
So what's the question you have to answer tomorrow?
The question you have to answer for yourself is this. Do you trust the headline price action that big tech is driving? Or do you trust the internal action of the real money that is aggressively buying crash insurance? Your strategy have to respect the volatility potential of that 7007 gamma pin. Stick rigidly to the levels, because the risk of failure is hidden just beneath the surface.